guys, this is Caitlin. I'm going to be showing you how to do a video exercise. Here's the first paragraph of the problem. I'll give you a couple of seconds to read it. Here's the second paragraph of the problem. Again, I'll give you a few seconds to read this part. And here's the final paragraph of the problem. We're also given the PV factors for both the lessor and the lessee, which we will be using a little bit later in the required parts. Now we come to the required parts. Question 1 asks, what is the discount rate Potter should use and why? To answer that, Potter should use its own discount rate of 11% because the lessee uses the lessor's rate if the lessee knows the rate and the lessor's rate is lower than the lessee's borrowing rate. Since the lessee, Potter, does not know the lessor's, Stein's, rate, we cannot use Stein's 10%, so therefore we have to use Potter's 11%. Question 2 asks, determine the amount Potter should record as a leased asset and a lease liability. To answer that, we need to find the PV of total MLP, total minimum lease payments. Now, I've included a chart with all of the numbers used in the problem and the annuity factors, which was also given in the problem. And we find that total MLP is equal to present value of lease payments less PV of executory costs included in the lease payments, plus the PV of guaranteed residual value. Those numbers are given in the chart, and all of that equals $542,984.75. Question 3 asks, what is the amount of sales revenue for Stein on January 1st, 2013? Since Stein will recognize sales revenue equal to Potter's MLP, we calculated the MLP above in Part 2, which was $542,984.75. So that will be our sales revenue for Stein on January 1st, 2013. The last part is prepare the appropriate journal entries for both Potter and Stein on January 1st, 2013 and December 31st, 2013, assuming the accounting period ends on December 31st. We will start with Potter, the lessee. On January 1st, 2013, we need to record the actual acceptance of the term and the actual payment for the lease. So the first journal entry we need to record will be a debit to lease machinery and a credit to lease payable. Both amounts are going to be $542,984.75, which we calculated from Part 2. The next set of journal entries we need to record is the actual payment. So that set of journal entries will consist of a debit to lease payable of $96,904 and another debit to maintenance fee expense, also known as the executory costs, of $596. Then we will credit cash for the full payment of the lease, or the lease payment, which is $97,500. For the year-end journal entries, all we need to record for year-end is depreciation expense and accumulated depreciation. Now, we calculated depreciation expense as $542,984.75 divided by however many years the term is, which is 7. So that number divided by 7 is equal to $77,569.25. That amount will be debited and credited to depreciation expense and accumulated depreciation. We now come to Stein, the lessor. We have 3 sets of journal entries to record for Stein on January 1st, 2013. The first set of journal entries is to record the actual sale or acceptance of the lease. The second one is the acceptance of the annual lease payment. And the third one is to take the inventory out of inventory and attribute to cost of goods sold. Now, to record the actual sale, we would debit leased receivable and credit inventory of equipment for leased machinery, and the amounts debited and credited would be $542,984.75. To record the receipt of cash from the payment, it would be a debit to cash of $97,500 and a credit to maintenance fee payable for $596, which is the executory cost, and another credit to lease receivable for $96,904. To record the third set of journal entries, it would be a debit to cost of goods sold and a credit to inventory of equipment for the cost of the machinery, which was $420,000, which was also stated in the problem. Now we come to the last set of journal entries to finish out part 4. And those journal entries are for December 31st, 2013 for Stein, the lessor. There is only one set of entries, and that's for the cash receipt of depreciation expense. And it's going to be a debit to cash and a credit to depreciation expense for $96,904. The $96,904 comes from doing an amortization schedule, and since it's only been 1 year, you only have a depreciation expense for 1 year, and that's 1 year's worth of payments. And since it is the first year, there isn't going to be any interest expense or interest payable, so there is no journal entry for that.